it's not necessarily fundamentals that drive the bubble. And I hear people say, well, I don't want to live in a world where it's $10,000 gold. Well, I don't know why not. The reason gold will be 10,000 is just because everybody thinks that they've found that pot of gold at the end of the rainbow, and so everybody's buying. It doesn't mean that the world's coming to an end. In fact, the world's probably, at that point, the world's already starting to get better. I kind of think that the 50, as long as we continue to hold above 50, which I think we are going to, that this is just going to ignite an even more intense short squeeze. And that's why I say my target for spring is probably $75. Might even be as high as $100. And I'm on record, $100 silver is going to be a piece of cake. Actually, I think realistically, $200 silver is a piece of cake, and probably $250. And then within the realm of possibility is $500 silver.
Garysavage explains that parabolic moves in precious metals are rarely driven by fundamentals alone. Mass psychology is the true accelerant. When investors collectively decide that gold and silver are the only real stores of value, prices can rocket far beyond traditional valuation models. Savage argues that a world with $10,000 gold doesn't imply collapse. It simply reflects a moment when confidence shifts and buying turns into a runaway short squeeze. Silver, he says, is already positioned for that dynamic. Holding firmly above the $50 level sets the stage for an even more aggressive upside move, with spring targets near $75 and the potential to stretch toward $100. Longer term, he sees $200 to $250 silver as easily achievable, with an outside possibility of $500 as momentum and crowd behavior converge. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
We may have to somewhat retest that bottom. Kind of looks to me like this is maybe going to shape up as a triangle with maybe 2 or 3 tests of the top, especially in silver, but then each low is a higher low. So when you look at it on a chart, it looks like kind of a flat-sided triangle, with the flat side being on the upper part, and then the higher lows on the lower part of the triangle, and those almost always break on the flat side. So I think we may have another weeks or 2 or 3, and then I think we're going to break out. And I got a target of probably 75 by late spring, maybe early summer in silver, and we might even get to $100 by then. But I definitely think we'll get to $100 by the end of the year. I also think I made this call last year when the banking cartel couldn't drive gold back below 2,000. That was where the suppression collapsed in the gold market. And then, we looked at that long-term chart. It's gone, just parabolic since then. That's the short squeeze in action. The miners also broke the suppression last year. And I think silver broke the suppression when they tried for weeks and weeks and weeks to hold silver below $33. Once it broke through that, then there was a few little hesitations along the way, but basically it made a beeline from 33 to 50 and even above 50. And now we've come back down for a brief move back below 50, but now we're back above it. I kind of think that the 50, as long as we continue to hold above 50, which I think we are going to, that this is just going to ignite an even more intense short squeeze. And that's why I say my target for spring is probably $75. Might even be as high as $100. And I'm on record, $100 silver is going to be a piece of cake. Actually, I think realistically, $200 silver is a piece of cake, and probably $250. And then within the realm of possibility is $500 silver. Well, I think that was kind of temporary. The shortage was in Europe, but there was a glut here in the U.S. So what happened was, I don't know how many tons of silver, was put on a plane and sent over to Europe to alleviate that shortage. So, but all the suppression has created shortages in the market. That's going to be one of the drivers. But sentiment's the main driver of a bubble. Usually by the time you get into the bubble phase, the fundamentals are already, starting to correct or go in the other direction. It's just that, like I said, people see their neighbor getting rich and they want to get rich. So it's not necessarily fundamentals that drive the bubble. And I hear people say, well, I don't want to live in a world where it's $10,000 gold. Well, I don't know why not. The reason gold will be 10,000 is just because everybody thinks that they found that pot of gold at the end of the rainbow, and so everybody's buying. It doesn't mean that the world's coming to an end. In fact, the world's probably at that point, the world's already starting to get better. So, $125,000 Bitcoin wasn't the end of the world. I don't know why $10,000 gold means it's the end of the world either. It'll just be sentiment. It'll just be driving a bubble like it always does. Silver's going to catch up. Gold's not going to go backwards, and then silver's going to ignore gold and go up. They're both going to go up, but silver's just going to go up a lot faster. And silver has a lot of catching up to do. The miners had a lot of catching up to do, but they did most of it this year. I don't think they're going to outperform silver this year. I think it's time for silver to do its thing and start catching up. And that's one of the things you want to look for. That's an indication that you're at the top of the bubble. When that gold to silver ratio gets down to between 20 to 1 and 30 to 1, it's time to start selling your metals, and then the bull market's about over. You won't get the exact top, but it's time to start looking for something that's undervalued at that point.
Silver's latest structure is forming exactly the tightening triangle that often precedes explosive upside. As Garysavage explains, each dip has produced a higher low. At the same time, resistance along the upper band remains flat, a classic setup that usually breaks to the upside once pressure fully compresses. He expects a few more weeks of consolidation before a decisive move begins. With silver holding firmly above $50, the short squeeze dynamic is strengthening, opening the path towards $75 by late spring and potentially $100 by early summer. Longer term, he still views $200 and even $250 silver as reasonable milestones, with an outside possibility of $500 as sentiment turns euphoric. Silver has significant catching up to do, and when the gold-silver ratio compresses toward 20 to 1 or 30 to 1, the bull cycle will be nearing maturity. Now, let's get into the interview.
They want to say that this is the beginning of the bull market, and I don't think it is. I think we're in the ending phase. And if you look at that long-term chart, it's pretty clear. You can see that first. These bull markets unfold in two phases. The first phase was from 99 or 2001. We double bottomed there, so take your pick whichever one you want to say is the beginning of the bull market. But that first phase went from $250 to a little over $1,900, and then you can see we had a bear market, a cyclical bear market within the context of a long-term secular bull market. But we had that cyclical bear market from that top in 2011 to the bottom in 2015, and in 2015, that's where we started the second phase of the bull market. So this is not just beginning. We're 10 years into this bull move. It just doesn't seem like it, because the first part of the bull market was kind of slow right here, and then we built out the handle for a couple of years, but then you can see what's happened, and part of this is in response to breaking the suppression in the metals market when the banking cartel couldn't drive gold back below 2,000. You can see what happened. It ignited this gigantic short squeeze as they got caught in their massive short positions. And it's still ongoing, but it's also, I think, in part due to that we're in the ending phase of the bull market. And the biggest gains come at the very beginning of a bull market and at the very end of a bull market. And it's pretty clear that this is kind of going parabolic at this point. My theory was the rule is once the general public kind of catches on to something, whether it be like a housing bubble or tech bubble or whatever, once they start to catch on that, hey, their neighbors are making money and I want to make money too, it takes about a year to a year and a half for that, all of the public that's going to come in to come in. And then at that point, you're out of buyers. And usually by that point, the fundamentals have changed too. So then the bubble collapses. So I think the public really started to take notice when gold crossed above 4,000. And now we're having a little correction to kind of maybe kick some of those people out. But I'm going to say, when we went above 4,000, that was the timer starting, and we probably got a year and a half, max maybe 2 years before we get to that top. All of these corrections over the last couple of years have been more sideways events, but still gold dropped $500. Silver corrected, I think it was somewhere between 12 and 15%, and miners corrected 20%. So this is what I was suggesting is going to happen, is the corrections will be compressed so they won't take as long, because you got retail traders, FOMOing into markets. So they're buying the dips aggressively, but they're becoming more volatile. So a 20% correction in the miners, that's pretty good correction. If you're leveraged, that's, you're pulling your hair out if you get caught in in something like that in leverage. So I think that's what we're going to be looking at as we go forward. Maybe the corrections won't last as long, but they're going to be volatile. And then once they're over, then we're back in the parabolic phase and heading up again. We have most of our capital in physical gold and silver. So the trading part is fairly small because these are kind of risky. You're trading leverage, like mostly options. Some people are trading futures. So we're not trading our whole portfolio in leverage. Most of the portfolio is in physical gold and silver. That just wait till we get to that 20 to 1, 30 to 1 gold silver ratio, and then we'll sell everything. But right now we're trying to produce outsized returns in our trading portfolio by taking leveraged positions at during these corrections like we're in right now. We're getting set up now for the next run higher. Now you can play all three if you want. You could do, and I know a lot of my subscribers do that. They'll play some in GLD, some in SLV, and some in GDX. But for me, I tend to want to focus in silver because I think it's time for silver to catch up. That gold silver ratio has a date with 20 to 30 to 1, and right now I think is maybe 78 to 1. So it's time for silver to catch up. The miners kind of more or less caught up this past year. So it's my opinion that silver is going to outperform everything else. So I'm focus there, but you can certainly, if you want to, you can play all three.
The current surge in precious metals isn't the start of a new cycle. It's the late-stage acceleration of a long bull market that began years ago. As Garysavage notes, gold's structure clearly shows two major phases. The first from the early 2000s into the 2011 peak, followed by a cyclical bear market, and then the second phase beginning in 2015. What's happening now is the compression and ignition typical near the end of a secular trend. Once gold broke through $4,000, retail participation intensified, helping drive a powerful short squeeze after the metals market's suppression finally failed. Corrective pullbacks are shorter but more volatile, with sharp swings in gold, silver, and miners. Silver remains the standout opportunity as the gold-silver ratio eventually gravitates toward 20 to 1 or 30 to 1, positioning it to far outperform during the remaining parabolic advance. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.